Let's take a look at the Chapter 15 homework problems. We'll start out with the computational exercises for the chapter. So I just have our book open on the computational exercises. Happens to be in your actual paper book. It's on page 25. And then I've got the ebook open obviously right here. So I'll start with question 13. Just a reminder that the discussion questions are before that. I don't typically go over those in the recording, just because I've given you the answers to those already. So just a good review is on your own in the class under my.usf. Go to handouts and you'll find the discussion question answers, and you can just review those questions and then the answers already. So it's a great review to prepare yourself for some of the homework assignments, tests, quizzes, and so on. Okay, so Chapter 15, Question 13, Helpers Inc. is a qualifying 501c3. They have a lobbying expenditure of $250,000 for the taxable year and grassroots expenditures of $0. Exempt purpose expenditures for the tax year are $1,200,000. Helpers elects to be eligible to make lobbying expenditures on a limited basis, which is a choice of the organization. They can choose to not make any at all. So letter A. What amount of lobbying expenditures is Helpers allowed to incur under the terms of the election? That's really what a big chunk of the chapter is ultimately about. So I want to, before we get into this, let me mention on page 6 of the chapter is a good reference guide for you. So any homework problems that you have that deal with this particular question for Chapter 15 to go to is to take a look at page 6. Of Chapter 15. So go there, and at the very top there's a little bit of a tax table there, and we're going to use that to solve this question. So let's go ahead then and solve basically what amount of lobbying expenses is that they're allowed to incur during the term. And the key is that they're at $1.2 million. And then if we go to that table on page 6, it says over $1 million, but not over $1.5 million. The lobbying non-taxable amount is $175,000 plus 10% of the excess of exempt purpose expenditures over $1 million. Okay, so I'm at that $1 million to $1.5 million range. Okay, so I'm just going to type in exactly what it says in page 6. It's $175,000, and then it's plus 10% of any amount over $1 million. Okay, so that's kind of the bracket that I'm in. There we go. So our company is at $1.2 million. So I'm going to type in $1.2 million. That's where we're at. That's how much expense we have. And so let's figure out what they're allowed to do. So it's $175. Okay, so for sure it's $175 plus 10%. So I'm going to say 0.1 multiplied by $1.2 million minus $1 million. Okay, and let's fix that. 20,000. So the sum of the two is what we're allowed to do, 195. So the lobbying non-tax amount is 175. So that's the amount we can do free of tax. Okay, so go back to the question, and it says that they spent 250,000. So they can do 195 free of tax, but clearly they spent more than that. Okay. Now the ceiling then is 150% of 195. So the ceiling is that times 1.5. So the non-tax amount is 195. The ceiling, the limit that they're allowed to do, is that amount times 1.5, which is 292.5. Okay, so they spent 250. So they're right in between these, which is just fine. So that means they'll pay a tax on anything above $250. They did not hit the ceiling, which is good because that would potentially jeopardize their non-exempt status. So they don't want to do that. So let's go ahead then. And question A, remember how it was worded. It said, what amount of lobbying expense is helpers allowed to incur under the terms of the election? Basically, anything less than $292.5. That's essentially the answer. So anything under the number right here, $292.5. Then question B is, what's the liability as a result of the election? Basically, what's the tax that they will pay? Thankfully, it's pretty simple. It's just taking the $250, subtracting the $195, and then we take that number, and let's see, I didn't do that right. 250 right here. There we go. So 55,000 times 0.25. So the tax you pay on that is 25%. So 25% times the amount over the non-tax amount is $13,750. So the tax they'll pay is $13,750. Okay, question 14. Davis is an officer for a 501c3. And Davis is going to receive a benefit that's inappropriate in the context of this particular charity in the form of overly generous health insurance. And so because of that, the excess is determined to be $35,000. Davis does not pay back the excess benefits to the organization before the first level tax is due. So this is kind of goes back to what was mentioned in the chapter, that there's some extra benefits you have to pay if you are, or some extra taxes to pay if you're an officer of a 501c3 and you are overly compensated. Okay, so basically it says, letter A, apply the rules for an intermediate sanctions and what amount of first level taxes are imposed on Davis, and then what's also imposed on the exempt organization's management. So this is the first level. They call the first level tax. The first level tax is 25% times the excess benefit. So Davis will pay a tax of 25% of the $35,000, or $8,750. So 25% of $35,000 for $8,750 is the tax on Davis. The organization will then pay a 10% tax on the $35,000, so they'll pay $3,500. Okay, so first level is Davis pays $8,750, the organization pays $3,500. Then we have the second level. So the second level only comes into play if Davis does not reimburse the charity for the $35,000. Okay, so if he does not reimburse the charity, he has to pay the second level tax, which is 200% times the benefit. So basically double the benefit, which is $70,000. Okay, so now that letter B, the answer is $70,000. Okay, then question 15, and we're just going to do answers A and C. I'm skipping the Excel thing here. Rejoice Inc., a private foundation, has existed for 10 years. Rejoice held undistributed income of $160,000 at the end of the year. Of this amount, $90,000 was distributed in 16, $70,000 was distributed during the first quarter of 17. The IRS mailed a deficiency notice to Rejoice on August 1 of 18 relating to the entity's undistributed income. This is a private foundation that's existed for 10 years. So remember, the rules for a private foundation are a little bit different. They kind of need to distribute their funds, or else they'll have to pay some taxes, which a pure non-exempt does not do. So you can see here then, for letter A, the initial tax on the 15 undistributed income for 16. So it's a trick question because they're trying to set us up for a scenario here. And the answer is that the initial tax applies for Rejoice for the 2015 undistributed taxable income to the extent that it's not distributed by the end of 16. So take a look here and see what the dates are. So they basically have until the end of 16 to distribute that. So income in 15 was 160. That means by the end of 16 it has to be distributed. Well, look at what they did in 16. Of this amount, 90 was distributed in 16, and 70 went to the first quarter of 17. So 90,000 was distributed in 16. And then for 16, then the tax will be based on the 70,000. Okay, so it's 30% times 70,000, the difference. Okay, so the tax is 0 for 15, and for 16, it becomes the difference 160 minus 90, which is 70, times 30%, which is 21,000. And then it says, what's the additional tax for 18? Well, by 18, everything was distributed because they distributed the final 70,000 in the first quarter of 17. So by the time we get to 18, everything has been distributed and there's no tax. So total tax paid is 30% of 70,000 or 21,000, which relates to 16. So there weren't very many computational exercises for this chapter, but we will go through a couple of the problems. So I'm going to go to problem 18. Let's go find it here. There we go. Problem 18 is right there. Wish Inc. is a 501c3. It pays unreasonable compensation to Renata, the treasurer of Wish. Renata's compensation is $600, assuming that reasonable compensation would be $500. Apply the rules for intermediate sanctions, determine any tax consequences for Wish Inc., determine any tax consequences for Renata. Okay. So it's safe to say that they have $100,000 of unreasonable compensation, the difference between 600 and 500. So that $100,000, then we have to apply the intermediate sanction rules. Okay. Now for the organization itself, that would be 10%. So the organization itself pays a 10% tax on the difference, 100,000 times 10%, which is 100,000. And then there's a cap on that of 20,000 per transaction. So they're well within that, obviously, but the maximum is $20,000. Okay. So that's what that question is. So what's that? The intermediate sanctions for Wish Inc. Then letter B is what's basically the sanction for Renata. Now this is 25%. So initially she's going to pay a 25% tax on that difference. So 25% of 100,000 we all know is 25,000. Okay. So if she does not fix that within the taxable period, in other words, she's got to pay that money back. If she does not fix it, then she's subject to second level tax, which is 200% or double the difference. So 100,000 times 200% is obviously $200,000. So she better fix it, right? Because otherwise that's very, very, very expensive. Okay, then question 19 is a pretty simple one, but it's one that I think we need to make sure we cover. 19 just says that Roadrunner Inc. is an exempt medical organization. Quail is a sporting goods retailer, is a wholly owned sub of Roadrunner. Roadrunner inherited Quail stock last year from a major benefactor of the medical organization. Quail's taxable income is $550. Quail will remit all of its earnings, net of any tax, to Roadrunner every year to support the exempt purpose of the parent. Letter A, is Quail subject to federal income tax? If so, calculate the liability. So hopefully, after we've gone through the chapter, you're going, yes, 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 yes. It is subject to tax, and absolutely 100% it is. So their net income, basically their taxable income, was $550,000 right here. And let's assume it's a corporation. It says Inc., so it's incorporated. They would simply pay whatever the C Corp tax rate is, which we all know is 21%. So take 550, multiply that by 0.21. That's 115.5, and that's the tax. So the Quail will pay a tax of 115,500, and then anything after that they can then send on to Roadrunner to support the organization. So they'll pay the tax and then send the remainder over to Roadrunner if they would like to. Okay, so they do pay tax. We're going to skip Part B of that, but I just want to make sure you understood Part A. And then we'll just have one more. That's question 20. Initiate Inc. is a 501c3, receives following revenue and incurs the following expenses. So they received some money from the Bill Gates Foundation, the Bill and Melinda Gates Foundation, charitable contributions received, expenses in carrying out its exempt mission, net income before tax of Landscaping Inc., a wholly owned for-profit sub. Landscaping remits all of its after-tax profits each year to Initiate. Calculate the amount of federal income tax, if any, for Initiate and for Landscaping. So the point of this question is just so you kind of separate the two income sources. So anything that Initiate itself as a 501c3 receives from a foundation, from contributions, that's non-taxable, right? And of course it has expenses, you know, it carries out its mission. So as it goes about and whatever it's doing, it's incurring expenses. That's all good. They're allowed to do that. There's no tax consequences for the first three items. The last item, though, Landscaping Inc. Incorporated, wholly owned for-profit sub, that's taxable. So $400,000 times 21% would be the tax bill, $84,000. So 400 minus 84 then. That difference could then be distributed back to Initiate to help support its mission and fund operations. Okay, so that was it. I think you'll find fairly straightforward. Actually, no, I'm going to do one more. Let me do one more. Then, but I think overall, I think you're going to discover that these questions are very, very straightforward. I'm going to do question 22. I totally forgot. Question 22. Gray Inc., a private foundation, reports the following items of income and deductions. Gray is not eligible for a 1% tax on net investment income. So now we're a private foundation, so remember there's a few more tax rules now because of that. Calculate Gray's investment income. So we go ahead and we take a look at their interest income here. We add to that the rent income, the dividend income, and the royalty income. Okay, so kind of take those four together. We subtract from that deductions, and you can see the deductions are 26,000. So anything kind of related is what belongs here. So I'll take the first 5 items, 1, 2, 3, 4, 5. I'm sorry, no, not the 80,000. So the 29, the 61, the 15, the 22, and subtract from those the 26. Okay, so the sum of those equals 101. So let me just type this out here just so you see what the numbers are. So it's 29 plus 61 plus 15 plus 22. The sum of those is 127. And I subtract the 26 allowable for deductions. The net then is 101. Okay, so the net left over is 101. Then so coming back to the question, neither the unrelated income of 80 nor the unrelated business expense of 12 are relevant in calculating net investment income. So we just don't need to include those. So then question B is, what is their tax on net investment income? And that simply is 2% times the 101. So 0.02, and we just take the 101 times the 0.02, and we get 2020 as the answer. Okay, so that is the end of what I want to cover to get you ready for Chapter 15. Thanks.